You're listening to What's Up Digital Lending, the podcast that explores the exciting world of digital lending. We make a deep dive into the most important issues and talk to the leading minds of the ecosystem.
Hi everybody, my guests today in this episode number 16 are Stefan Pomberger and Matteo Bernadoni, both board members of the Swiss Marketplace Lending Association, SMLA in short, and Marco Hinz and Stäuble, board members of our association. My name is Constantin Fabricius and I'm the host of this podcast. It's the first time we have two trade buddies from different countries on the show, and that's really great. We definitely want to continue this with others. Warm greetings to our wonderful colleagues in India, Canada, Kenya, USA, and wherever you are promoting the interests of fintech lenders. Today's show is, as the title suggests, about the current situation in digital lending. We discuss the market, growth factors, the fintech lender bank relationship, and ideas for a better regulatory landscape. I hope you enjoy listening and please subscribe to stay updated on new episodes. Before we start, however, listen carefully to the following. The content of this podcast is expressly not to be considered investment advice, but is intended solely for your information. We do not assume any liability and will not share any profits. Okay, let's start talking. Welcome to the show, Matteo, Stefan, Patrick, and Marco.
Hi, Constantin.
Hello.
Hi, Constantin.
Everybody.
So, could you please introduce yourselves briefly? Who are you and who are you speaking for today?
I can maybe start. Hi, everyone. I'm Patrick Stäuble. I'm the founder and the CEO of Teylor. Teylor is an alternative lending platform from Switzerland, but focused on multiple European countries in the meantime, focused primarily on SME lending. I'm here today as CEO of Teylor, but also as a as a director of the Digital Lending Association.
Yeah, maybe I'm next. I'm Marco. I'm CEO of CrossLend, which is a securitization as a service company bridging capital markets and fintech lending or digital lending. And I'm also a board member of the Digital Lending Association representing here today. And I'm very curious and happy to be part of that cool podcast.
Thank you. Stefan.
Hi, everyone. I'm Stefan Pomberger. I'm heading Cosmofunding here at Bank Vontobel. What we do is we connect issuers and investors via public bonds, private placements, and loans. And I'm a board member at the Swiss Marketplace Lending Association.
Perfect. Thank you. Matteo.
Hello, everybody. Constantin, thank you very much for having me. I'm Matteo Bernadoni. I've been working in the lending field for the last 20 years around in different functions, mostly within the banking segment in Switzerland. And today I'm here in the role of the president of the Swiss Marketplace Lending Association, SMLA, which is an association which brings the stakeholders of the marketplace lending in Switzerland. And we are pleased to be also with you in terms of this cross-border collaboration.
Thank you very much, guys. Let's do a warm-up round. In Asia Pacific and the Americas, increasing smartphone and internet usage heavily boosts digital lending activities. Indonesia, China, India, USA, Brazil, just to mention a few, are experiencing high digital adoption rates, contributing to the surge in online lending. So what's up at the macro level in digital lending in Europe? Who would like to start?
I can start. I mean, I think the interesting part about the macro level in Europe is how stark the differences are between some markets. So if you look at maybe the DACH region, where probably the penetration of digital lending is very, very low compared to some of the markets that you mentioned, but also compared to markets like the UK. In the UK, there was a study published, I think, last week or two weeks ago from the local associations that, for example, in the SME lending space, something like 60% of new loan originations are coming from alternative lenders, specifically in the SME lending space, but it's probably not too far different in the retail lending space. While I would guess in the DACH region, we probably have less than 5%, maybe even less. So the really interesting thing when you name all of these countries, for me, Constantin, is the catching up that probably we have to do still in the DACH region, or even better, the opportunity that we have. I don't know, Matteo, if you guys are seeing a big uptick in kind of digital applications and stuff like that, or how you guys are managing this.
We do. I absolutely can echo that. I think on the digital side, i.e. the front end, customers are increasingly using the digital channel in order to get to their financing. It depends, of course, on the kind of financing you are currently be looking for. So customer space, customer finance space, and also some part of leasing financing, some part of SME financing. There we see a lot of digitalization going on the larger part of the credit, and also for mortgages. We see still the development in this direction, but we see also the predominance of the physical channel, because there you are talking about larger amount of money, and you do want to talk to a person in the normal circumstances. But I think that's a trend we should not oversee for the future, because also in that space with the a fantastic development also towards digital models. In terms of the refinancing space, also there, I think in Switzerland we have almost a decade of experience in getting especially mortgages, but not only being financed by third-party lenders, so not typically banking financing, but pension funds, insurers, and so on and so forth. So we see the development is also from that perspective there. I think, Stefan, maybe if you could add with regard to the public sector, that's been a development which was remarkable over the last years, right?
Yeah, thank you, Matteo. Yeah, I mean, what we see is a lot of growth in that market. So I fully agree with you all that we in the DACH region, we do have below 5% market share in the digital space yet. But what we see is on an annual basis growth rates that are very, very strong. And this is very promising for the field, because there's currently a lot going on in private debt market as well as in the public market. And when I look at it, even public bonds are more and more digitalized and more and more end-to-end now, as they have been before. So I think there is a transition going on, at least that what we're observing is the transition to basically from a 90s model, 80s, 90s model to a more digital model. And what we also do observe, and this is quite interesting, that once a client is actually with a digital model, that the stickiness, the refinancing that you were speaking about, Matteo, this is really interesting, because there's such a high retention in the digital model. So I would say it takes some time to move the clients from traditional physical ways to the digital space. And in the end, let's not underestimate it. We have to do with large sums of money and large financing volumes in the market. I mean, the Swiss market as general is 1,500 billion per year. Most of it in the mortgage space, and then followed by other spaces, public sector, SME, etc., etc. But this is quite a bulk of volume that we can address here, and a huge potential in the market.
Yeah, maybe I would also like to add something, because we heard already a lot of good things, and I like the term transition, which Stefan mentioned, because all the countries that you mentioned before, Constantin, in LATAM, for example, they don't have such a legacy which we have in Europe. And this is why the more emerging markets are faster, have more data transparency, have more API-first approaches, which makes it much more easier to do the entire risk assessment. And this is what we are, especially in Germany. I mean, Germany is so overbanked. We have 370 saving banks. We have 700 community banks, and we have the private banks. I mean, you have a bank every 10 meters if you walk through the city. It feels like that. And the thing is, in terms of technology and especially data availability, because risk assessment is always data availability question, right? And standardized interfaces to access these kind of data. What you can see in the Netherlands, for example, in the last couple of 20 years, what happened there, that the predominant financing for mortgages turned completely away from banks to insurance companies, pension funds, and so on and so forth, because what happens in the Netherlands is that the entire value chain of lending just get separated in the verticals. You have specialized entities who are on the side of lead generation for these kind of loans. Then you have specialized providers which just only do risk assessment on a very sophisticated technology-driven approach. Then you have some companies which are massively in the servicing and backup servicing, debt collection part. And then in the end, you have someone who's financing all of that, but don't have the expertise for the sector. And this is only possible because, and this is also what we see in Germany right now, in the mortgage space, you have players like Sprengnetter, for example, which offers you really in seconds evaluation of your specific mortgage. Because the data are there, the data are digitized. You have also smart meters where you can consume energy consumption, for example, where you can derive a kind of energy efficiency index for the building and so on and so forth. And this is what Europe needs to speed up from my point of view in comparison to all the other emerging markets which you mentioned, because they don't have all the legacy and they don't have these GDPR topics which we have, which is also a bit of challenging here and there. But I think we are on the way to get this done. And we also have very good players in our association. I think also in the Swiss association, there are players who do the job very, very good. But it is data availability tech first, and then we can pick up with all the other ones.
That's a very good point, actually, Marco. I think the infrastructure argument is very important to have it fixed. We do observe this as well. So the amount of investors that the issuers can reach over a platform is significant, and they save a lot of time and in the end also money, obviously, because the issuers usually have two aspects that they're interested in: a good rate, so a very competitive rate, and safety, so to really get the money then if they close it. It's mostly coming down to this, except if there are more complex stuff, for example, in infrastructure projects or so on. And the infrastructure side, providing it via data on the one hand, and on the other hand also via securitization, so having an ISIN number, having it bookable in your account, custody, whatever. This is also generating quite some volumes and momentum in the industry. And then you have special effects in Switzerland about the mortgage market, for example, because you were addressing it. Here, maybe you, Matteo, can give your thoughts, because it's a really interesting development currently, what's going on in Swiss real estate, being one of the big fee pools in the market.
Yeah, I absolutely agree, Stefan. And it's a huge market in Switzerland for mortgages. As you mentioned, more than 1 trillion of mortgages in Switzerland, 1,100 billion of Swiss francs being granted as mortgages. And I found very interesting the point from Marco with regard to the Netherlands market, where you've seen pension funds and insurers in the market coming in. I think in terms of the penetration of these kind of investor in Switzerland on the mortgage market, we're still around 5 to 6%. So it's mostly banks dominated, as perhaps in other jurisdictions in Europe yet. But what we saw is also the fragmentation of the market. So you see the market, especially for short-term loans, being still financed by banks, because it suits maybe for their balance sheet, whereas for longer maturity, you see more and more pension funds, which are actively also offering 10 plus years of mortgage. In Switzerland, you have normally the traditional mortgage market between SARON, the short-term mortgage, and 10 years, whereas investors like pension funds and insurer are bidding for longer maturities, like 15 years, even 20 years, which fits to their balance sheet perhaps better because they have long-term liabilities. So if you look also from a financial stability standpoint of view, I think we are fragmenting the market in a way which is going to be more and more stable if you would like to have asset and liability matching of the exposure.
Thank you for elaborating specifically in view of real estate loans. What about consumer and SME finance? What are you able to tell the audience about these segments?
I mean, that's primarily the area that we're in, SME finance. I think it's a pretty interesting phase in the market, especially for fintechs such as Teylor, because I think that you have probably for the first time in many, many years a very difficult environment to be coming into the market as a fintech lender, alternative lender. You have multiple kind of things coming together. The VC market investing into the fintech environment is very much lower than it was a couple of years ago. It's the first kind of, let's say, down phase in the credit cycle, where I think a lot of fintechs or people who started lending a couple of years ago are getting confronted for the first time with a down cycle. And you do see that obviously there are less fintechs in this space, and the ones that are there obviously probably don't have or have more challenges to survive than they've had in the past. So the way that we look at it is that now it's probably not the time where a bunch of new entrants are going to come into the market and gain a lot of market share, but the ones that can kind of survive the phase are the ones that are going to come out strong. But this in turn opens a door for other market players, right? Especially for the traditional lenders who maybe have a more stable revenue streams than the fintechs do, to kind of finally start digitizing this space, which you see in Germany that some are doing. But still much slower than I would expect. I think in the majority of cases, if you look at the majority of banks in Germany, they haven't significantly invested, at least in the SME lending space, into digitizing this process. Retail is probably 5 or 10 years ahead, so classic consumer finance. But at least in the SME lending space, it's a great opportunity for the traditional lenders that very few of them so far have been doing. And because the playing field is relatively open, just because there's not many new entrants coming into the market at the moment.
How do you currently see the situation, Patrick, in Switzerland with regards to Basel III, with the new environment? How is it going on the issue side currently?
I think right now it's not even so much Basel III that is relevant for the Swiss market. I think it's the fact that you have the Credit Suisse UBS merger, because I think you have a lot of players in the market who noticed. If you guys recall, a couple of years ago, around or just after the financial crisis, you had Credit Suisse taking over the Neue Aargauer Bank in Switzerland, which was a very strongly anchored kind of SME bank and regionally anchored bank. And Credit Suisse, there was a gap in the market there afterwards, and nobody really took advantage of it. And now with the Credit Suisse UBS merger, obviously there is, UBS probably certainly has different criterias and risk appetite perhaps than Credit Suisse have, or even than UBS had in the past. So there is a big market gap. And I think that there is, SMEs who maybe were previously Credit Suisse clients who want to diversify their funding sources and stuff like that. And you do see in Switzerland, I think, more players coming onto the market now. Credo, the Swiss fintech, just did a big launch with some very, very talented staff and big investors behind it. So I think this has led to a very interesting situation where in Switzerland, you actually have a lot of support for kind of digital lending at the moment, probably more than you have in the German market, where you don't have this kind of UBS Credit Suisse situation. So I'm relatively bullish on the Swiss alternative lending market, because I think that the demand is there, and the market changes have led to kind of a significant boost of demand, more than there was previously.
Thank you. Let's also talk about municipal financing, please. This seems to have come to an end, at least from my point of view. Once there were around 7 fintechs doing business in this area in Germany, for example, but today there isn't even a single one left. The same is true in many other European countries. So why did it not work out so well in this segment? What's your take on this?
Yeah, maybe I take this question, Constantin. Thanks. So, because we are quite leading in the sector of public sector and municipality financing, what Switzerland is concerned, we have obviously observed that dynamic for Germany and Austria, exactly the dynamic you were speaking about. In Switzerland, it's twofold. So at the one hand, it is really a very tough and challenging competing market. So in the way of the margin is very low in the sector, public sector, municipalities, cities or cantons, in German Bundesland are concerned. So we are dealing here in a market with very low margin. On the other hand, the attractive point, and that's what makes it twofold, is it is scalable to some extent. I would say that, at least from my observation in Germany and Austria, it's far more difficult because of regulation. GDPR, as an example, this is a problem because of getting the right reach. So that's one point. And another point is the structure of the market. So in Germany and Austria, the municipalities, risk profile wise, it's not like here in Switzerland where there is a competition about taxes, and here the municipalities want to be attractive, that new inhabitants come in that have tax power, and they're really competing for the good taxpayers. Whereas in Germany, Austria, it's rather or less the same. And if one municipality in Germany fails anyway, the government maybe will pick it up and help out. Here in Switzerland, a municipality could really go bankrupt. And this is now also the point that you get a credit spread on this and you get compensation on it. And we have here an ecosystem where we work together with a rating agency that is approved by the financial authority, FINMA. Here in Switzerland, they're called Federfin, so they rate every municipality and every city. and according to the rating, there's a different outcome on the margin they're getting. Nonetheless, the market is highly competitive. There's not much space what the municipality financing is concerned, and you really need to come up with solutions in that part. I would say that doing loans only in the municipality market is a dead-end business, because there's no real advantage for the municipality to having this loan business being further pushed. The reason being is there are some players in the market have more than two hands, but not that much more in the municipality market. And if you know them, you know them. So you need to provide your clients with an extra service. So I think here points come in about securitization, that you securitize it, that you check things from a regulatory standpoint, what anti-money laundering is concerned, checking the payment streams, being a paying agent, for example. These are services that are very important and that are paid for. And this makes the market attractive, combined with the semi-public side of things. So being like in the energy companies being partially owned or fully owned by the municipalities or a consortium thereof, up to hospitals, up to water treatment plants, and so on. So I think you can take this for the way how I see the municipality market here in Switzerland. It's a low fee pool market. But it's a market where you have visibility, where you connect, where you get more connections by doing more business than in the semi-public and other sectors in corporates, for example. In Switzerland, you have to see that the way how we operate in Switzerland is it's a lot based on a elite system. So this means that people do this on a voluntary basis very often, to be the head of finance of a municipality, or so really voluntarily. And they do have corporate functions, as an example, in their professional life as well, in their business life. So, and maybe they're a CFO of corporate XYZ, and then you do business there as well. So the cross-selling part makes it attractive. Whereas in Germany, Austria, I would say the structure is different. If I assume, so maybe you can help me on this and give me some rope, but my assumption is, at least the municipalities I know, I come from a small village from Austria. What I am observing is they have a full-time job as an officer at the government, and they don't have a parallel job in the industry, and this makes it difficult, right?
Okay, thank you. Yeah, let's shed light on the investors' side. What can you tell us about the development of retail and institutional investors? What's the trend? What do you see, guys, in the market?
I mean, I think that we are seeing that there is a lot of demand on the private debt side. So I think the really cool development that's happened probably for all of our industries, or for all of our specific areas, is that over the last maybe 5 or 10 years, there's been a really significant private markets boom, where probably 5 years ago or 10 years ago, if you were speaking to maybe a smaller asset manager, they wouldn't really have a private debt allocation or anything like that. While now it's kind of it's a very mainstream topic. Which is great for us, because it means that, if you can offer an interesting asset class, or if you can, if you have a good track record and you can give something unique, there is capital out there from institutional investors who from small to large, who want to invest into this space. And I think that's very, very positive, because I think it means that, if you have a good product, if you are in a good segment, etc., that you are able to get it funded. Now, obviously, it's going to be interesting to see how that develops with the interest rate environment developing. But I'm sure, Stefan probably works also a lot with various asset managers and institutional investors, and the demand side is very good. That's something that we're quite happy about.
I can fully confirm that, Patrick. So, there's still quite a lot of money around in the market. We, as a platform, we only do have contact with institutional investors. We are a B2B service platform. We do B2B4C, but then it's always B2B4C in this channel. So, and we do see from the order of importance, I would say it is pension funds, corporates, then asset managers, banks, trusts, high net worth individual family offices. This is the area of investors that show a lot of interest on investing. And insurance companies is important when it comes to the public bond space. When you do really the higher fee pool business, really a public bond topic, there it becomes important, similar to what you said, Matteo, on the liability matching on long-term liabilities.
I think one point where I was personally disappointed is the development of the retail space, the peer-to-peer lending landscape in Switzerland. At least we do not see that much of a dynamism there. We were expecting a stronger growth rate. If we look at the Asia-Pacific markets, we see that much of the private debt, peer-to-peer lending, alternative lending space is driven by retail investors. What we do not see actually in Switzerland, that's still a niche, which is financing, especially the consumer and SME segment, small and medium enterprise segment. But it has remained really a niche in the overall market. And what we're seeing, and perhaps that's also a question to Marco, is a surge of the securitization market with regard to the synthetic risk transfer. So we see a lot of banks in Europe, but also in Switzerland, using that part of the synthetic securitization to get access to their books to institutional investor without performing a true sale. So that's something we saw in Switzerland and in Europe, and it would be nice to get your opinion, Mark, on that.
Yeah, maybe some comment before. So what we see, at least in Europe, and also I think overseas, is that you usually have some entity, fintech lender, digital lending, whatever, is starting with equity, friends and family, whatever, then maybe tap into retail investors, and then you come into a plateau where the financing is not sufficient anymore, but the demand is still high, and then nearly everyone we saw or see in the market then just turn away from retail investors and go to institutional investors, because there's a kind of endless amount of funding, or it feels like this. But then, of course, at some point, there's another plateau when then the demand in the market is enough. So I think we saw a lot of institutional players, and I think also Patrick and Teylor did a quite good job with various different kind of structures that they put out to the capital market side. What the thing is also what Stefan mentioned, yes, all the institutional players are out there, but they are very specific to the form of investment. There are very, very few professional or institutional investors who takes the loans or the receivables directly on their balance sheet. They always want to have a structure in between. And the most conservative ones, like the insurance and pension funds, would like to have a rated bond, because a rating from two agencies, they know what they are buying and then they're fine with. But applying a look-through, and even in Germany, to the Solvency II regime, for example, insurers are not allowed to invest in consumer loans or retail loans, for example. So there's a lot of regulatory change that also needs to be done to be at least at the same position like other countries or other regions. But institutional investors are driving the entire digital lending scene, I would say. So the part of private money, even family offices, they're doing a tiny part of the overall funding situation in Europe. You have big banks, especially in the UK and in the Nordics, which are running around and putting money into this market across Europe. But also, I would say 5 years ago, there were some very ambitious players in Portugal, which were banks, and they did a really good job on this part. But also there, the regulator just stepped in and put enormous RWAs on these kind of investments, because the regulator in Portugal don't want the banks to invest outside of Portugal, even if they have enough money. And for example, in Germany, you have a very similar situation. So we have the saving bank sector, which is doing, I think, 40-50% of all the SME loans in Germany, but not in Eastern Germany. In Eastern Germany, you have so many money in the banks and deposits, and they are just not allowed to invest it outside of the region. So they are sitting on a massive amount of cash, and they are looking for structures where they can invest into SME loans, for example, in other regions. Because in entire Europe, there is enough money, but it's always about the access to the point of sale, let's say it this way, to really have an entrance door into the sourcing capacities of whatever loans. And then, of course, speed, risk assessment, and risk management, and all the other things. But again, the Nordic institutional investors and the UK institutional investors, they have understood it, I would say, 10 years ago, because they are running around Europe with a shopping cart and invest in all the good digital lenders across Europe.
Yeah.
So, and one thing, and to the securitization, so it doesn't really matter if we talk about a synthetic securitization or a true sales thing. From the digital lending space, it doesn't matter. But for example, we had a project with a huge bank in Spain, and the bank want to sell their assets to another investor. But then you have topics, which is a little bit absurd, because then it's a question, if I do a true sale, then my balance sheet will shrink. And the guys who are doing this in a bank are not incentivized by this KPI. They're incentivized by balance sheet size and not by, let's call it, fee generation of servicing. So then you have someone in the bank which just say, no, I want to have a synthetic securitization because then it's still on my balance sheet, because then I'm incentivized to sell off these kind of loans, for example, to come into these loan origination as a service model, right? So, but the form, to your question, Matteo, this doesn't matter. It's really an individual situation, incentive scheme question, what is needed. Is it a synthetic one? Is it a true sale one? Is it a uni-tranche one, looks through, pass through? Is it buying the receivables directly on the balance? Maybe you need a fund, an IEF in between. This is really, honestly, up for every single investor. It's a new question.
Yeah, no, I can agree. And I can also kind of tag on with a funny story that also we notice obviously very clearly that the Scandinavian or the Nordic and UK banks are significantly further ahead than the remaining European ones. So we've had many times the funny situation where we're explaining to the UK banks, how does the credit rating work in Germany? How does the underwriting work and stuff like that? And they still have more appetite and are faster to get the deal done than, for example, the German banks, who in many cases have their own SME lending portfolio. But this whole area is still much newer in the market for them compared to the Nordics and the UK based lenders, which is why ultimately, for example, we work with Barclays as our senior lender, because they've done 100 transactions of this type in the UK. And it's a core part of their business.
Thank you very much. That's a key word. Banks. Let's talk about the relationship of banks and digital lenders. How is the relationship evolving? Partners or competitors? On what fields?
I think in Switzerland, there is quite an openness with regard to fintech and working with fintech. So we see in the different part of the markets, not only the split up of the value chain that was alluded before, where banks are actively cooperating with fintechs in the field, but sometimes banks are creating their own platform, their digital lending offering on their own, or they are acquiring stake in platform in Switzerland. So we saw both from banks, insurer, and also pension funds this trend not to consider strictly these new kids on the block with regard to the credit market as strictly competitors, but also as a chance to get to new customer, to be more efficient in terms of the processing, and also to open up their distribution network to potential new lender. Nevertheless, I think the market is still small, especially if you're going to finance the single loans through third party lenders. So there we still see that the one-to-one relationship is working on a small level, particularly for the mortgage business. Whereas if you tap into other parts of the alternative lending space like securitization and so on, there you can really move the needle and then get to larger exposure that you can get either off balance sheet or synthetically transfer to other counterparties, or even use the exposure for covered funding. I think that's something Swiss banks used to do through a dedicated foundation scheme, which is in Switzerland, but also to dedicated covered bond programs that they have here in Switzerland and they use.
Okay, let me bring into the discussion two more keywords, and this is embedded finance and open finance. How will this exert influence on the bank fintech lender relationship in the future? What do you think, guys, about this? At least in the EU, open finance plays really a humongous role. I don't think I am exaggerating. And we see already in Great Britain how this has exerted influence in the past 10 years. So what is your expectation in view of these two keywords, of these two areas that I think are going to play a major role for the bank fintech relationship?
Certainly, Constantin, I think so. On the first point, certainly partners. I think the Swiss Marketplace Lending Association shows that quite well because we are quite diverse, having banks on the one hand side as members of the board and of members of the association, but also all the platforms. So there's quite a variety and consensus here. So and I think the point what the technologization is making to banks it's massive. So because clients can in the future decide, do I want to get the information stream? So Marco was talking about data before, and we all were talking about data points. The clients can now decide, do I want to get my information stream by an artificial intelligence or by some embedded machine, or do I still want to rely on my relationship manager who could go on holidays, who could be sick one time, etc., etc. So I think of course, I think the hybrid model will be around. So, in a way that the technologization helps to the relationship manager to handle more clients in less time. But I think this enrichment by the software, and here I think the fintechs can play a big role offering software as a service to banks because they move faster than banks. Looking at sometimes how IT departments are run at banks, it really takes tremendous efforts to get things done, and because of different reasons. So here we obviously often see that having a fintech in the back, from who you could buy a SaaS solution. So this can work in my opinion, and the market landscape will change dramatically. I think, especially what the amount of workforce needed in the future is concerned. So I think this will be a big turning point in the market. So especially if now someone tries to enter banking newly with little background or little education, I think it's very difficult in the future.
Perhaps one point I would like to add here. I think that's a huge opportunity with regard to the fintech coming in with new technology. I think we should keep in mind and bear in mind that splitting up the lending value chain bears also some risks. Because at the end of the day, when you have a process which is fully owned by one banks or one insurer and so on and so forth, you have kind of an alignment of interest if the bank is also financing the loan it's currently granting. If you start to split up the value chain, you should ensure that there is an alignment of interests of all the parties involved, so that you do not end up in having moral hazard, adverse selection, and so on and so forth. And there, I think both banks, fintech partners, incumbent, and so on and so forth, they should really also bear this risk in mind when we do create new models to tackle this lending space.
Thank you. Stefan, you have mentioned earlier Basel III, and this is something at this stage I would like to drill a little bit deeper with respect to the special role of banks as institutional investors. So what one could argue is that banks refrain from lending for different reasons, such as Basel, rather, and then investing, preferably investing into these digital loans. So please elaborate a little bit more on these aspects. So what do you think is the future development with respect to such regulations? Because it is not Basel III alone.
You very good question, Constantin. Thank you. So I think on that point, what we have seen so far, because we talked about municipality finance before, for example, for a bank giving a loan to a municipality or giving a loan to a real estate fund, for example, or to some real estate corporates with higher LTVs, as an example, it became, due to the regulation, very unattractive. And in particular for banks, that don't look at it they always look at it from a cross-selling perspective. So in the way of, does this client have any other business relationship with me in a higher fee pool asset? So as an example, if I lend him now on my balance sheet, does he book assets on the other hand, be it with a Lombard loan or be it some asset management mandate that the client gave me as a side of the pocket, where they can also get additional fee income as a bank? So banks they have triaged more, so they are really more selective now in the way of looking how to distribute their assets, their asset behavior. So this is an effect that we clearly see in general in the market. So in particular, this is to the worst for the clients of I would say good quality clients, but clients that were always pushy for getting the cheapest offer. So clients who always were pushing for the cheapest offer, but didn't have any other relationship with the bank, these are rather not wanted anymore. And being not wanted is reflected in either increasing the margins. So this is one way to say no to a client, or on the other way, not even giving an answer what particular real estate transactions are currently around in the market. Because what I feel is we are overwhelmed currently, as an example, by real estate requests. So really people asking for financing for the reason of Basel, for the reason of cantonal banks being more active in their home canton and not abroad from their canton. So there are different dynamics in this field. And this is vastly what we observe. This is a huge opportunity for the other institutional investors that get access to this material, to the investment opportunities they couldn't access before. And here we come to the point of Marco on the rated bond, be it a public bond or a private placement. I think the structure here is important, especially for a pension fund or for an insurance company or for a corporate or also an asset manager to fit into the investment committee regulations of the individual institute. And obviously they are now part of filling up the gap. This is a process that is currently going on and fully underway. That's how we see it currently.
Yeah, perfect. To add some color to this discussion, looking at the Canadian Lenders Association, for instance, or the Digital Lenders Association of India, so two very different regions, we can see that today there is really a very high number of banks and fintech lenders below one roof, and they all found their way together. And for instance, the Canadian Lenders Association is by far bigger than any other organization in Canada, and the same is true as regards our colleagues from India. And these are only two examples. I could add more, but what it shows is that it makes absolutely sense to find a common way of understanding when it comes to digital lending. Yes. Thank you, guys. Before we close for today, I'd like to highlight regulation. That's very important as well. And what I would like to know from you, how do you assess the political and regulatory climate in Europe? What ideas do you have for improving it? And what should SMLA and DLA perhaps even tackle together?
I think it's an interesting question, Constantin, because probably the Swiss and the German or EU ones, it's the two that probably have the least cooperation, I would say, from a regulatory standpoint. So, I mean, I can't speak too much to the Swiss market or regulation. I think in Germany, it's entering obviously an interesting phase with the new government. I think it'll be very exciting to see if there's maybe more support for what we're doing. At the same time, I think it clearly has gotten to a point where the BaFin and the regulator does want our industry to be more regulated than it was before. Be that with, putting the fronting bank model under more scrutiny, creating licenses and routes to licensing that are strongly encouraged by the regulator that maybe in the past we didn't need to do. So I think looking at the future for companies like ours, at least in the EU or specifically Germany, it is a nice outlook with the new government, but it's certainly a more regulated outlook than it was maybe over the last 5 or 10 years in our space specifically.
And what's about securitization, Marco? So that's really an issue that is relevant not only for the EU market, it's relevant for Great Britain and Switzerland as well. So what's your take on this?
Very quick response to Patrick. So I think the regulatory framework still has a very different view on banks as a lender and on digital lending or fintechs as a lender, even if they have, on the quality side, very similar risk management procedures in place and so on and so forth. And they're doing a good job. They have shown it for the last 20 years that they know what they're doing. But still, there is a very, very different perception of these kind of two different things. What I would wish, for example, what we can see in the UK, especially in the Corona situation, where the support schemes are released by the government, also the entire fintech lending space in the UK were able to grant out these kind of support loans or support schemes. And it worked out pretty well. And in Germany, we also have support schemes, but in the end, after long consultation and a lot of long meetings, only saving banks and the community banks were allowed to grant out these kind of stuff. And there was back then a huge called Fintech Alliance, which were part of this kind of consultation, which try to also achieve the same thing that was happening in the UK, but doesn't work out for a reason, whatever. So I think this kind of perception needs to be changed and needs to be thought together. Also what you said or what you mentioned, Constantin, before, that in other regions of the world, fintech lending, digital lending, banks belong together kind of, because in the end, it's all about funding, right? We have one part also which Stefan mentioned. You have the technology part where you can do a lot of new things fast, which the banks cannot do properly in the same speed, but they need to belong together, because in the end, also when we take a look at who are the main investors in digital lending and fintech lending, we talk about the institutional investor side, right? Honestly, these are big banks providing the funding for that. So you see already that there is a kind of cooperation, but very selective, honestly. Regulatory-wise, fintech lending, digital lending is just penalized with a lot of things, like my example in Portugal back then, where you have to pay insane RWA on this exposure for the bank. In regards to securitization, I mean, securitization is one of many tools to bridge institutional or capital markets players with, let's say, the real economy. It's just a bridge between the originator of the loans and then the capital market side to fund these kind of loans. So also if you take a look at the securitization volumes, it's picking up again. So it's growing. We have the STS regime, which is also growing massively, which also has transparency and data availability as some of the core principles, which is good. But in the end, honestly, especially in Germany, I would say there's still a long way to go to make the best out of it, what the potential is there, right? I mean, we have like Teylor, good players with a very technology-first driven approach, which is doing an amazing job. There are other parties as well. But honestly, it needs that the entire industry needs to work together, because banks are very constrained in the region, for example, very constrained in their processes and procedures, or allowance what they can do, what they cannot do. One thing, for example, especially in the SME space, and maybe Teylor or Patrick has a view on that, if you go to your regional saving banks as a more or less big corporate and you want to have an additional loan, you will run into limits, like a cluster limit or a client limit. So the bank can't serve you anymore. Then you need to run into the syndication, where you need a couple of other banks to come together to enable your growth, for example. And all of this can be easily fixed by technology or fintech or digital lenders, because they are already doing this kind of pooling on the institutional investor side, right? So I think there are much more synergies which need to come to play, which I don't know honestly why, but I assume there are a lot of protectionisms on the banking side, because again, my example in the Netherlands, banking and real estate doesn't play a role anymore. It's just 30% of the entire market, and the other 70% is done by other players in the market. And this we'll see over time also in other categories. I mean, if you take the funding situation in the US, completely different. So capital markets is funding the entire US life, and banks are just a minor piece of it. And I think this is something where we need to change our mind, where we have to rethink the capital market union in Europe, especially, where we need to make the money flow across the entire region. And then there can be a huge potential for growth if we change the mind.
I would like to add that point, Marco, if I may. I mean, why do we even talk about regulation? Because something happened in the first place, right? So it is a matter about risk management, and talking about risk management in the end, that matters and that is important. So the question is to us as an industry, as overall, we have to be careful and mindful about defaults, in my opinion. So, and if defaults occur, if they happen, it must be clearly communicated already ex ante what is the risk for the client to bear. So that's why we are a big fan of a certain form of regulation. So in the sense of having the right infrastructure, be it securitization on the one hand side. Securitization is important for having a clear depository, for example, an exchange. Having a rating on the other hand, such that the client is aware, do I have a rating or don't I have it? Having the technology as an example, looking now to Patrick on the screen, so as an example to you, Matteo. I mean, these are all important ingredients to get the risk management right and avoid conflicts of interest and setting the scene, because what we want to do is we want to diversify the funding base for the issuers in the end, we as an industry, and we want to ensure that the market is working and continuously working in the future. What we have to be aware of that some people they will exploit it at some point, especially because they know we want growth. So there will be a potential default line, and this one is the one to set the needle and to say, well, you could get it, or you as an issuer you can't because you don't fulfill criteria A, B, C. And I think this is something we should be mindful about, because let's keep in mind, I mean, the US is currently doing very smart. I mean, they're deregulating. In a sense, so we in Europe we shouldn't speak more about regulation. We should think about smart ways how to avoid mistakes in the first place, because that's in the end what matters: a clear risk management.
Yeah, 100% agree. I would like directly to respond to that. So I'm a fan of regulation, right? Because then everybody knows exactly what's going on, what you can do, what you cannot do. And I mean, in the US, it's like something, everything which is not denied is allowed. And in Europe, it's different. It needs to be allowed, and everything else is denied. So, and of course, we have a lot of hiccups back then in 2000, in 2001, 2007, 2011, and so on and so forth. All of this is a good thing, but the important thing is that we are not harm ourselves by too bureaucracy driven, by too tightened regulation. Because I mean, a lot of things like Enpal, which is a huge solar supplier in Germany, they also done a big securitization to finance their stuff. But I mean, they know in advance what's going on, because for their photovoltaic stuff they are building, they have smart meters, they can measure everything, they can predict data in advance, for example, together with open banking, where you have access to all the information, which you haven't in 2007, which you haven't in 2011, and so on and so forth. It comes back to a technology-driven first approach, because right now, the PD, the probability of default on your loans, is basic on a statistical, historical view, right? And then what is really matters is the LGD, is the loss given default in the end, what really comes out, which you cannot really predict. But to be more precise in this kind of stuff, you need this kind of cooperation between fintech lenders and traditional banks, because it is about stability. You are completely right. Regulation is all about stability. It does make sense, of course. But the way how we are doing this needs to be changed, because otherwise we will just fall back to other regions. And I mean, you know, the current situation which we have, especially in Germany, but also in Europe, it is quite difficult. And we need to change the minds that we have to be more innovative. Because right now, we are still, if you go into the bank today, you have 5 KPIs measuring your creditworthiness and you get a loan. I mean, you can do it much more sophisticated right now, and you can do much more prediction on this kind of stuff to assure the stability.
Yeah, but I think it's also a risk to now put everything on the regulation or on the protectionism of banks. I don't think that's the point in here. I think banks have shown that they are open to new models. I think regulation is, for instance, very benign in Switzerland. So if you come from a regulation point of view, pension funds could invest up to 50% of their assets in mortgages. Now they are at 2%. It's not because of the regulation, and it's not because of the protectionism of banks. It's because sometimes it takes time. And it's also, I think, I like the point with regard to collaboration. It's a collaboration to show also the attractiveness of these asset class to institutional investor. And that will take time. And I think I always refer to a quote which is related to technological change. We tend to overestimate the speed at which a technology will change the market, but we tend to underestimate the long-term effect of these new technology. And I think with that sentiment, with that quote, we should collaborate all together, not saying that we need less regulation or we need less protectionism from banks, but working together to show really the market that it can be more efficient, it can have a better risk reward perspective on the different asset classes, and it can even create a better financial stability through the better allocation of loans to the right balance sheets that would like to invest.
Thank you very much for these final words. So let's stop it here and let's go back later to this discussion at another point of time. Guys, we have come to the end of today's show. Thank you so much for your time, Matteo, Stefan, Marco, and Patrick.
Thank you very much.
Thank you very much.
Thank you very much.
Thank you everyone for listening. I hope you have enjoyed the show. Please subscribe to our podcast and let us know what you thought of this episode. Stay safe and sound and see you soon.